Hello everyone, Dan Borrero, USA Land Ventures, bringing you another episode of Golden Nuggets. Our mission at Golden Nuggets at USA Land Ventures, our mission is to bring to you different levels of entry into the real estate market on how to invest, different strategies on how to invest, as well as multiple different platforms on where to invest, what type of properties. It doesn't matter if it's commercial, condos, townhomes, parking space, multiple family, commercial. That's what we're looking to cover throughout the entire series. If you like the series and you like this video, please subscribe on the button below and give us a thumbs up at the end of the video. Having said that, today we're going to talk about a condominium that we bought back in 2012. We actually bought it in April of 2012, and we just sold that property last month in 2020. The reason we're bringing this particular property up is because we want to show you how we made money through cash flow, and then at the end when we sold the property, and then how we took that money that we got at the end of the property when we sold it and how we reinvested it. Having said that, the average rent over the period of the 8 years that we owned it was $875. However, the current rent today is at $925. Before we did the renovations, it's probably more at about $950 to $975 right now. The total rents that we collected were $84,000 over a period of 8 years. Our carrying costs were approximately $4,300 per year. What's included in that carrying cost? HOAs, your real estate taxes, miscellaneous issues. Those are the things that were included on that. Then those total carrying costs for the same period of time was $34,400. Having said that, our total rent was $84,000. Our total carrying cost was $34,400, which left us a net profit of $49,600 on the profit of rent collected over those 8 years. Now let's fast forward to the acquisition of the property, which is what you guys are probably wondering right now. It was $20,800. We bought 10 units. We took the 10 units when we bought them, divided it by 10 for the total cost. Each unit came out to $20,800. Now, we went into our offense and our defense. So what we did was we sold 7 units of those 10. The profit from those 7 units paid for the 3 units that we kept. Right. So flipping gave us the profits, which was our offense. Defense was putting it into long-term cash flow. Now we took those profits, we invested it, and we paid back the loan that we had. The loan was paid back for all 10 units within 6 months. Then we spent a total of $4,700 in maintenance, minor repairs through the course of the 8 years. We spent $11,100, and that included the major renovations that we did right before we sold it. Why? To distinguish our unit from everyone else that was selling in that community at the time, as well as to get more money on the resale. Our total cost for that property was $36,600. Now, we netted on the sale before taxes, after we paid our what they call estoppel fees, after we paid the real estate commission and all our closing costs, tax stamps, and everything else. Our total net was $73,900. I rounded all these numbers down to the nearest 100th. Our total cost on the acquisition was $36,600. Our total profit on rent collected after all of our expenses, remember, our carrying costs, HOA, real estate taxes, miscellaneous, was $49,600. So our total profits was $86,900. That's right, guys. For an original investment of $36,600 totaled within the entire 8 years. That's 237% return. Why did we sell it if we were making money? That's the next question that you should be asking. We sold it because this particular community, the HOA, had been going through some serious changes that we were not finding favorable. Our time would be better spent in another community that was more receptive to real estate investors, as well as a community that was running a lot more efficient. Although the HOA costs in that community with taxes is about $110 more per month, we're averaging an extra profit of $190 per month after all the expenses. In addition, that community has a history of going up in value between 6 and 8% per year, even in these tough times. Having said that, it made total sense to move our money from a defensive position to a better defensive position, because it's still going to grow in value. It's still going to give us cash flow. We're going to get a better quality tenant, and we're going to spend less time running it because the HOA is that much more efficient. Guys, you could take the same exact example and you could implement the same exact example into purchasing a mobile home, a 2-family property, a garage space that you might want to rent, an area, or what I call infill lots, which is high density within an area that has multiple family properties where the cities themselves give out a lot of parking tickets. Take a vacant lot, rock it, fence it, rent out parking spaces. There's multiple ways to take the same exact example of what I just gave you with a condo and implement it into different real estate strategies. If you have any questions, feel free to reach out to us. We love paying it forward. Dan Borrero, USA Land Ventures. Have a wonderful day. Take care.